Welcome to The Explainer. Today, we're jumping right into the stock market because, well, we've got some seriously conflicting signals, and we need to figure out what it all means for your portfolio, especially as we head into a month that's, historically, a little tricky.
So, let's set the stage. We've had this fantastic run since the spring, right? But now, the market is staring down the barrel of September. And September is, let's be honest, a notoriously weak month. So the huge question on every investor's mind is pretty simple. Where do we go from here?
And this really is a tug of war. On one side, you have the bears, and they're seeing all these warning signs flashing. They're looking at history, and it's making them nervous. But on the other side, the bulls are sticking to a classic mantra. The trend is your friend, and price, well, price is innocent until proven guilty. It's a real showdown between caution and optimism.
All right, let's dive into the case for caution first. The core idea here is pretty intuitive. After months and months of steady gains, the market is kind of like a stretched slinky. You know, it's been pushed and pulled for so long, and at some point it might be ready to snap back.
And a huge reason for this caution is just the calendar itself, seasonality. And look, history doesn't lie. When you look back over the last 50 years, September consistently, and I mean consistently, stands out as the single worst performing month for the S&P 500.
And hey, you don't have to take my word for it. Market strategist Dave Keller put it, well, pretty bluntly. He said the seasonality just sucks in the month of September. There's really no way to sugarcoat it. The data is just undeniably poor.
But it's not just about the calendar. Technicians are seeing three classic warning signs. First, you've got weakening breadth. Think of it like an army where fewer and fewer soldiers are actually joining the charge. Second, weakening momentum. Basically, the buying pressure that got us to these highs is just running out of steam. And finally, leadership rotation. The star players, the big tech names that carried us, are starting to get tired, and that often signals a major shift.
Okay, but that's only one side of the story, right? Let's flip the coin and look at the other side of the argument, which really boils down to one of the most fundamental rules in all of investing.
And that principle is that price is innocent until proven guilty. It's so simple but so powerful. The idea is that a trend, in this case an uptrend, stays in effect until it definitively, absolutely breaks. And right now, the primary trend for the market is still pointing up. And look, this isn't just a feeling. The charts back it up. If you do a quick health check on the major indexes, from the big S&P 500 all the way down to small caps, they're all still technically working. They're making higher highs and higher lows, and they're holding above those key moving averages. You just can't argue with that price action.
So, if the old leaders are starting to fade, but the broad trend is still holding on, the real key is to figure out where the new strength is coming from. This is all about spotting that leadership rotation as it happens.
And one of the first places showing some serious new life is the financial sector. The bank ETF, KBE, is actually breaking out. And if you run a scan for stocks making new highs, you're going to see individual bank names popping up again and again. That's a huge clue. And inside this sector, traders are getting really excited about a classic bullish pattern called the cup and handle. This is one of those textbook setups that often shows up right before a stock makes a really significant move to the upside.
And for a perfect example of this, just look at American Express. I mean, it is forming that exact cup and handle pattern as we speak. Now, if it can clear that key resistance level up around $330, that could trigger a really significant rally. It's not just banks either. Another sector that's been kind of quiet but is now showing renewed strength is the home builders. You know, they've been under pressure for a while, but now they're starting to outperform. And that might be because the whole interest rate environment is maybe, just maybe, starting to shift in their favor.
So, how does all of this actually translate into specific ideas? In a market this divided, it's really about knowing when to play offense and when it's time to play a little defense.
So let's talk offense first. One powerful strategy that institutional investors absolutely love is to look for what they call a fat pitch. So, what exactly is that?
It's actually pretty simple. You're hunting for a really high-quality stock, one with a great long-term trend that's just temporarily on sale. It lets you buy into that underlying strength, but at a much better price, which gives you a fantastic risk-to-reward setup.
A perfect example of this exact setup playing out right now is Meta. After just an enormous run-up, it has pulled back to test two critical levels, its old breakout level and its 50-day moving average. For traders looking for that fat pitch, this is exactly the kind of weakness they are hunting for.
Now, let's switch gears and talk about the tactical side.
Even with a stock you might love for the long term, like Nvidia, there can be some really interesting short-term opportunities. Just a simple technical retest of its recent breakout level can mean a potential drop of, well, anywhere from 12 to 18%.
So, what's the short-term case against it? Well, after that unbelievable run, Nvidia's short-term trend is broken, its momentum has been called, and I'm quoting here, disastrous, and it's no longer outperforming the market. For a tactical trader, those are just some pretty big red flags.
What's so fascinating is you can find these dueling perspectives even within the same industry. It's almost like a choose-your-own-adventure for investors. Take restaurants, for example. Do you go for the defensive stability of a blue-chip dividend pair like McDonald's? Or do you swing for the fences with the aggressive growth potential of a recent IPO like Dutch Bros?
So with all these conflicting signals floating around, what is the actual game plan for September? I mean, how are you supposed to navigate all this?
Well, the key takeaway here isn't to be fully bullish or fully bearish. It's about being prepared. So here's a simple framework. Number 1, acknowledge the warnings. You have to be aware of the weak seasonality and those technical cracks. 2, respect the trend. Don't fight this primary uptrend until it is clearly, definitively broken. And 3, hunt for strength. Shift your focus to where the new leadership is emerging, in places like financials and home builders.
And all of this leaves us with the ultimate question for September. As we head into this really volatile period, the market's fate truly rests on the answer to this. Is this rotation into new sectors a sign of underlying health, or is it just the beginning of a much broader decline?